Happy Monday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. I have an announcement for the channel, which I look forward to introducing to especially regular viewers of China Update. We'll touch on that shortly, but first, we have a major development in the US-China technology war, so let's jump in. NVIDIA Corp and Advanced Micro Devices Inc. have struck an unprecedented agreement with the Trump administration, pledging to hand over 15% of their revenues for certain chip sales to China in exchange for export licenses. Under the agreement, confirmed by people familiar with the matter and being reported separately by UK-based The Financial Times and US-based Bloomberg, NVIDIA will share 15% of revenue from its H20 chip sales in China, while AMD will contribute the same percentage from sales of its MI308 chips. The US Commerce Department began issuing licenses for the H20 on Friday, just 2 days after NVIDIA CEO Jensen Huang met US President Donald Trump at the White House. Licenses for AMD's chips were also issued. Now, this agreement is without precedent. Export control experts say no US company has previously been required to pay a portion of its revenues as a condition for obtaining export licenses. But the deal reflects a broader pattern in the Trump administration of using leverage over companies to secure commitments that bring money or investment back to the United States. As regular viewers of China Update know all too well, this arrangement came after months of uncertainty. Earlier this year, the Trump administration froze sales of some advanced chips to China as trade tensions spiked. In April, it announced a ban on the H20, which NVIDIA had designed specifically for the Chinese market in response to earlier Biden-era export restrictions on high-end AI chips. That ban was reversed in June after Huang's meeting with Trump, but licenses were still delayed until last week. Bernstein analysts estimate that based on NVIDIA's earlier guidance, the company could have sold about 1.5 million H20 chips to China in 2025 so far, if they were permitted to, generating around $23 billion in revenue. The 15% levy would therefore translate into billions flowing to the US government, though officials have yet to determine how the funds will be used. This decision has ignited controversy in Washington. Critics argue that the H20 could bolster China's military and artificial intelligence capabilities. Lisa Tobin, a former National Security Council China expert from the first Trump administration, expressed, for example, quote, "Beijing must be gloating to see Washington turn export licenses into revenue streams. What's next? Letting Lockheed Martin sell F-35s to China for a 15% commission?" End quote. Matt Pottinger, another former senior US official under the first Trump administration, and 19 other security experts, recently urged Commerce Secretary Howard Lutnick to block H20 sales, calling the chip a, quote, "potent accelerator," end quote, of Chinese AI development. NVIDIA rejected such claims, calling them misguided, and insisting that the H20 is not suitable for military applications. Quote, "While we haven't shipped H20 to China for months, we hope export control rules will let America compete in China and worldwide," end quote, the company said in a recent statement, warning that the US must avoid repeating its loss of leadership in 5G technology. The revenue-sharing agreement comes as the US and China engage in sensitive trade talks. Trump is seeking a summit with General Secretary Xi Jinping, and the Commerce Department has reportedly been instructed to pause new export restrictions to avoid jeopardizing negotiations. Beijing, meanwhile, is pushing for ease controls on high-bandwidth memory chips, another vital component for AI development. This deal marks a turning point in US export control policy, one where commercial access to China's vast market is increasingly tied to direct financial contributions to Washington, raising both economic and national security concerns. Now, before we move on to the next couple of developments, I had a small announcement that I wanted to make about the channel. For those who are not interested, the chapter feature will allow you to skip to the next part of the video, but for everybody else, I've always said that I want this channel to be primarily financially supported by subscribers and not have a corporate reliance or a corporate bias. My commitment to this remains the same. However, over the last few months, this financial contribution from subscribers, direct subscriber support, has unfortunately declined. As such, recently I've been thinking about how best to respond to this issue. I've had a lot of people telling me that I should put videos behind a paywall and that this is a very lucrative way of supporting the channel financially. However, I've also always committed to having all videos free and open for all. One of the reasons I started this channel was to contribute to having better conversations, more informed conversations about China, and that that means having all episodes available. So all episodes will continue to be free and open for all. What I've decided to do is to try to add more value for those who do support the channel financially. As such, over the weekend I launched a new exclusive piece of content, a weekly newsletter that covers the biggest developments in China from the week. Now, financial supporters of the channel, whether these are YouTube members, Patreon supporters, or Buy Me a Coffee members, will have access to this weekly newsletter, which I will publish myself at the end of the week, covering the biggest developments in summary from China from the last 7 days. My hope is that this adds some extra value for existing supporters, and I hope it's attractive to potential new supporters too. The first one was already posted over the weekend, so existing supporters have access to this already, and going forward every weekend a newsletter will be released. Now, if you want to have access to this exclusive content, these weekly newsletters on China, and you've been thinking of helping keep this channel going, supporting independent YouTubers and independent media, it's available to all financial supporters. You can go to Patreon, Buy Me a Coffee, or use the membership link on YouTube itself. And once you're signed up, you'll have access to all of these as well. For those who are unable or simply do not want to support the channel financially, all episodes of China Update will continue to be open and free. I've always wanted to be 100% transparent with funding for the channel, so I appreciate you listening to this here, and I want to thank all those who have supported the channel, whether it's financially but also just watching and sharing. Thank you for all the incredible support. I hope to continue to do this for years into the future. Thank you for helping me contribute in this modest way to the world having better, more informed conversations about China. Now let's continue with the episode. Lithium prices and mining stocks surged Monday today after CATL confirmed it had halted production at a major mine in China, fueling expectations of broader output cuts amid Beijing's push to curb industrial overcapacity. Tianqi Lithium Corp jumped as much as 19% in Hong Kong trading this morning, while Ganfeng Lithium Group gained 14%. Prices of lithium carbonate futures on the Guangzhou Futures Exchange hit their daily 8% limit, with the most active November contract climbing to 81,000 yuan. $11,200 a ton. CATL, the world's largest EV battery producer, suspended operations at its Jianxiawo mine in Jiangxi province after its mining license expired on the 9th of August. The company said it is applying for a renewal and plans to resume production, quote, as soon as possible, end quote, adding that the stoppage will have minimal impact on its overall operations. Its shares rose up to 2.8% in Hong Kong. The global lithium market has been under pressure from oversupply and slower electric vehicle demand growth, with prices brutally crashing almost 90% from their 2022 peak. CATL's move is seen as a short-term boost to market sentiment, though analysts caution it won't immediately alter the supply glut. Shares of Australian lithium miners also rallied, with PLS Limited up 19%, Liontown Resources gaining 25%, and Mineral Resources climbing 14%. Traders are now watching for potential curbs at other mines in Yichun, China's lithium hub, which could further tighten supply and push prices higher. Regular viewers of China Update know that overcapacity, especially in the auto industry, which is going through a brutal consolidation, has become a source of deep concern for Beijing and China's major trading partners alike. Latest numbers, which were published today, suggest this overproduction is accelerating. China's car industry extended its record-breaking streak in July, with production, sales, and exports all hitting all-time highs for the third month in a row. Passenger car production rose 12% year-on-year to 2.229 million units, according to data from the China Passenger Car Association published today. Retail sales climbed 6.3% to 1.826 million units, while wholesale volumes surged 13% to 2.221 million. Exports, including complete vehicles and knockdown kits, jumped 25% to 475,000 units, also a monthly record. Numbers are surging. In the new energy vehicle NEV segment, retail sales advanced 12%. New energy vehicle exports surged 120% to 213,000 units, marking the highest monthly total ever. BYD, Geely, and FAW Volkswagen led the market by sales. Geely stood out with 202,000 units sold, a 71% surge over last year, while BYD's sales slipped 12% to 45,000. Tesla fell outside the top 10, a drop CPCA Secretary General Cui Dongshu attributed to the rapid technological gains of domestic brands, which in some cases have surpassed Tesla in consumer appeal. He also cited geopolitical tensions and consumer boycotts linked to CEO Elon Musk's ties with the Trump administration. Cui noted that the domestic market is moving away from cutthroat price competition, helping profitability across the supply chain. The sector's profit margin hit 6.9% in June, its highest in years. While this could be a sign of healthier industry growth, we note that Beijing has rolled out massive consumer subsidies to promote the purchase of autos, so this may not be sustainable. With insufficient domestic demand, these cars are being exported. As with these surging numbers, we should expect major partners, especially the EU, to become increasingly concerned. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you for a new episode tomorrow.